this presentation. As you note, we are recording this presentation and it will be provided for anyone who attended after the presentation is over. Again, thank you for joining us to discuss CPACE and why and what it is and how bankers could use it potentially to help round out their projects and create more value for the properties that they own. We are co-hosting this with Philadelphia CPACE. I'm Shannon Crooker with Sustainable Energy Fund. We have a panel moderated by Cliff Kellogg from the CPACE Alliance. Jean Fields is here with us from Fulton Bank. They've already consented on 3 projects here in Pennsylvania, Philadelphia specifically. And then Doug Hoffman, who's representing Keystone Property Group, one of the owners of one of the first projects outside of Philadelphia that closed at the end of last year. So we're excited to have them here with us to talk about CPACE and why a banker might want to consent. I'm with Sustainable Energy Fund. We're a nonprofit that is designed to advance the barriers associated with sustainable energy, whether it's finance, education, or promotion of energy efficiency and renewable energy. We felt that CPACE was really in line with our mission of advancing energy and making it more accessible to the public. So it really rolled in really nicely with some of our programs, which includes energy financing from a very conventional standpoint, education, and then special projects. We tried to change things up year after year. CPACE was something that was a special project for us, but now it's become one of our standard programs. Sometimes you'll see, like right now, we just moved into a net zero energy building because we want to walk the talk. So that was considered a special project for us. But I know you're here to learn about CPACE. So what is CPACE? It's an innovative financing instrument that is tied to the property, and it provides long-term financing for energy and water conservation measures. It's interesting, and it's different than standard financing because it's tied to the tax of the property. So the tax bill, it's collected just like our property taxes are collected. And in an event of a delinquency, it's going to be collected in the same manner. It increases the value of property owners' property because of the operating income of the property goes down. As a CPACE administrator, we're looking to make sure that the projects meet the guidelines from both an energy perspective, as well as the regulatory guidelines from the statute, which here in Pennsylvania is Act 30. And like I said, it's collected through a special assessment. Not the best word here in Pennsylvania, because whenever we hear assessment, we automatically think it's gonna trigger assessment on the property where it may increase the value and increase the taxes, but that's not what it is. It's a separate special payment that's collected in the same manner of taxes. And it stays with the property. So in the event of a sale, the new owner will start taking on future payments. And it's just like any other payments that may be due in that year. It could be negotiated with the buyer and seller on how much they're going to divvy it out and pay a portion of that taxes or the special assessment special payment. So how is CPACE used? In most instances, you see it's really widely used for energy efficiency upgrades. So far in Pennsylvania, we've seen that's pretty standard. We've had one solar project in Philadelphia. In other states, resiliency is also allowed. Here in Pennsylvania, that's part of the expansion package that's in front of legislation right now. We're hoping to see that towards the end of the year. Here in Pennsylvania, commercial and agricultural properties can use CPACE to upgrade their facilities, which includes industrial, retail, farms, nonprofits, and private schools, because no municipalities are able to use this financial tool. And multifamily is not allowed right now in Pennsylvania, but that's also part of the expansion package. And there's a pretty strong push for multifamily because Pennsylvania is one of the few that does not allow it. Nationwide, it's over a $2 billion industry, and it's increased tremendously year after year since 2010 when it was first enabled. And I want to say that was California. In Pennsylvania, in the first year from July 20th, when projects first started coming through, it was, I should back up a second. In 2018, that's when CPACE was passed in legislation. There was a strong, lengthy stakeholder process to get the guidelines straightened out and all the legal contractual documents that go with a CPACE transaction. We didn't see our first project, and that was in Philadelphia in July 2020. By 2021, a whole year later, over $22 million has been invested in CPACE in Pennsylvania alone. It creates jobs. Over 24,000 jobs have been created nationally. There's over 30 states that have enabled CPACE. And there's a whole host of ones that have active programs, including many of our neighbors like Delaware, Maryland, and Ohio. New York is coming online with a revamp, as well as New Jersey, who is creating their program as we speak. Here in Pennsylvania, there are 16 counties on board, including Philadelphia, and which I think I mentioned earlier. Philadelphia Energy Authority administers the program for everything in Philadelphia. Sustainable Energy Fund administers the program outside. So far, for all the counties in green, we're hoping that we can have a completely green map soon. And if you have a project or know of a customer that might benefit from this program, please go ahead and reach out to us, because we're, as the program administrator, we're tasked with getting counties on board and activating the market. So please let us know. And we've found that commissioners and counties are much more motivated when they have an active project in the pipeline in their county. So the benefits for a property owner are great. One thing that's really nice about CPACE, 100% of the cost, both hard and soft, are included, and there's no money down are required. So any of the engineering costs, lead consulting, everything else, and any of the ancillary costs. So if you needed to replace your roof to go solar because it's not structurally sound, that can be rolled into this financing package as well. The terms are long, which is really nice. They extend to the useful life of the equipment. Standard financing usually goes 5 to 7 years. So this is a really nice option to help lower that payment. And then of course it displaces expensive mezzanine debt. That's one thing that's really nice about it, so that property owners can preserve their capital. And they have an option to make their money go further by using CPACE instead of having to look for a higher interest finance. And then the cost can be passed on to the tenants, so it overrides the split incentive issue, and it allows for longer payback periods. HVAC equipment is not something that you're going to see a real fast return on investment, as opposed to LED lighting. So it's really nice that it will match the life of the equipment as well as the return on the investment. Here's a great way, a visual graphic of how CPACE works. It can be used to reduce the overall average cost of your debt, which is on the left, or you can expand your projects and do more. And this is specifically geared towards new construction, but it's also obviously for straight retrofits as well. And you can see on the left, the lowest cost of debt is your senior debt, and then sponsor equity is more expensive. So CPACE kind of offsets that and helps stretch your dollars further. So how does it work? So generally, a property owner is going to work with an engineer, and they're going to develop their project and find a capital provider. CPACE is usually boutique special capital providers in this market, but of course a bank, if they wanted to, they could choose to be a CPACE lender as well. They're going to submit their pre-application, and during this phase, we're looking to make sure the project is eligible based on the statutes and make sure there's no liens or outstanding taxes due on the property. So we really need to work with the county to get everything rolling. Once they're given the green light in that process, they further develop the project and start deciding and designing out what they're going to use to implement to achieve energy conservation and water conservation measures. During the final application, we're going to need an energy analysis that's going to confirm what the estimated savings are going to be, what the useful life and the overall cost of the project, the line on in budgets. During this phase, we're going to make sure that we have lender consent. And that's where bankers really come into play. A CPACE project is not going to move forward without lender consent. And it's because this, the first year or whatever the assessment that's due at that time is going to be senior to the mortgage. It does not accelerate. So any future payments will stay with the property, but that year will be senior and it's going to be collected just like the property taxes first. So that's one of the main reasons. And obviously the banks want to know what they're invested in and make sure that there's value in the property. So CPACE with these upgrades that property owners are implementing often increase the value of the property. There's other items that are also included in the final application. Most of them are administrative, to include like a title search, insurance. There's contractor requirements that are also necessary. But as a program administrator, we're here to support and work with the project team to make sure we get everything, to make sure that all the I's are dotted and the T's are crossed on a project. So both Sustainable Energy Fund and the Philadelphia Energy Authority are here to work with the project. So if you have any questions, please reach out to us. And once the application is reviewed, the contractual document is called the Statement of Levy and Lien. That's going to be recorded with the title of the property. And this is a four-party agreement essentially, because it's signed by the county and it's signed by the program administrator, the property owner, as well as the cap provider. And it provides all the details on the assessment and what's going to be due, starting when, and what the actual cost is going to be every year. So and it has all the legal jargon, for lack of a better word, that most contracts have, to include release and identification, liabilities. So it's pretty much like any other closing. It's the legal contract that's going to do. And once that's said and done, the funds are dispersed, and then the program administrator will work with each county to make sure that these are billed out, because the county is responsible for billing the property owners for the CPACE payments. These are some of the eligible improvements to include energy efficiency, renewable energy. I'm going to just go through these rather quickly because of this is more for bankers. I think you're more interested in the capital stacks and how that works, but please know that it has to have energy as well as renewable. And we're looking for specific things depending on whether it's new construction or whether it is a retrofit, which we're usually looking for 10% above baseline. 20% if it's new construction, but that's different in Philadelphia. Here is the SOAR West project, which Doug is the owner, the developer of. He will be talking a little bit more. This was a really great project to close at the end of December 2020. It was almost $10 million. I felt like Sustainable Energy Fund feels like we're somewhat in a race with Philadelphia to see who can beat. And this one was a really great one because it was 3 or 4 Philadelphia projects. It was a really great project because it's a historic firehouse that they're reusing, as well as an addition to a hotel, which I'm not going to steal the limelight. I want Doug to be able to talk a little bit about this project. I think it's a great one for Conshohocken. So as we move forward, he'll tell you a little bit more about the project. This is another one outside of Philadelphia, and a mixed use residential / construction, and we had to pull out the residential. That's one thing we had to make sure that we're clear here in Pennsylvania. Since multifamily is not allowed, it has to be separated and condoized so that it does not get mixed in with the CPACE assessment. That's it. I'm going to pass it on to Cliff from PACE Alliance, who's going to moderate and introduce the speakers.
Thank you very much, Shannon, and thank you for giving us the overview on CPACE. My name is Cliff Kellogg, and I am the Executive Director of a trade association of CPACE financiers and CPACE attorneys. And I should say that my background is as a banker in the private sector. I was president of a community bank here in Washington, D.C. for 6 years, and also as an official at the Treasury Department. So I'm very familiar with the economic challenges and the operational challenges of building a secure commercial real estate loan portfolio. We have two guests today, Doug Hoffman, who's the developer of the project that is pictured behind him in the screen, and also Gene Fields from Fulton Bank, who has some familiarity with CPACE as well. So the theme of today's session is not just commercial PACE, but specifically the role of lenders' consent in the transaction. Pennsylvania law is very clear on this point that it is essential for the property owner to obtain written lender consent prior to CPACE financing going forward. Our association of financing companies believes that lender consent is not just essential as a legal matter, but we think it's an element of good quality underwriting to have the lender as an independent set of experienced and knowledgeable financial experts look at the transaction for its viability. Lenders choose to consent on these projects because they believe that value is still in the project and that the financing terms do not hurt either the bank or the lender or the property owner, pardon me, in the transaction that's involved. And it is worth saying that a lender could decline to consent for any reason at all. If you have concerns about the property owner's understanding of the transaction, or as a mortgage holder, you have concerns about loan to value, those are all valid, and you may have other reasons that you decline to offer that consent. But we're here today to offer some explanation for why you might consider providing that consent. So I'd like to turn to Doug because we all, as lenders, value our customer relationships incredibly and know that a satisfied customer is, of course, critical to building our successful business. So it's interesting, Doug, for us to hear a little bit about your transaction. Well, first, let's start maybe with a word about your background and experience as a developer, and then we can turn to the particular transaction, if that's okay. So please tell us about yourself and your experience as a real estate developer and owner.
Thank you, Cliff. You introduced me as a developer. Our development team is phenomenal. I'm just the numbers guy. Some of the folks on this call might recognize Bill Glazer and Rich Gottlieb and Mike Brookshire. They are the guys who really put this together. I just mess around again with the numbers. I've been with Keystone since 2018, CFO, Chief Accounting Officer, in other industries actually. Prior to that, I go way back to Arthur Anderson, if anyone recognizes that name, back in the 1990s as an accountant. I've learned a lot here, obviously at Keystone. The SOAR project, which is more than the hotel, which you see behind me. That's the last piece of a development for AmerisourceBergen's world headquarters, which we started a few days after I started, and they are in the process of moving in. About 430,000 square feet here in Conshohocken, with about 11-story parking garage, a plaza in the middle, and this hotel, which when we purchased the land to build the hotel, it kind of came with this historic firehouse, which is 1873 Conshohocken firehouse, and in a bit of disrepair since it hasn't been used in a while. but some really neat features inside. And we're able to preserve some of those. It is actually on the historic registry. And one of the, I guess, benefits of COVID, if you can call it that, is that we had to really look at, we had to redesign and restructure the how we were going to build the hotel and the firehouse. And ultimately, the best plan was to combine them. So you can sort of see, behind me, the entrance is really part of the historic firehouse. And that's where the lobby is going to be. There'll be a bar area, sitting area, as well as the entrance to the restaurant, all opening onto an open plaza across from the entrance to the AmerisourceBergen headquarters. So that got underway in the first quarter of this year. As Cliff mentioned, we closed the financing in December. We'll be done with it next summer. And it's from a financing perspective, CPACE was an easy thing to add to our cap stack. In this instance, not the least of which, because you all know that financing any hotels in the teeth of COVID was not a particularly easy task. And we had multiple, we actually have 3 lenders on this one. We also have EB-5 funds. We received state and county grants on this. So we've got kind of a broad pool of capital sources. And CPACE clearly made sense for us. I believe, as Shannon alluded to, there are different requirements for new construction versus renovations. Very simply, building above code to get qualified with the CPACE cost. So that's part of the interaction that our development team, as well as our builder, had with our energy engineers, obviously to make sure that we had qualifying costs, as well as where financially feasible, to make alterations or improvements to our plan, to make sure that the cost did qualify.
So Doug, you come from such a well-known company and have this beautiful project behind you. I'm sure you had financing alternatives. You have a complicated capital stack there. Why did CPACE enter the picture? Tell us from the point of view of a property owner, why would you choose CPACE as a source?
Sure. So I think the easiest way to say it is to ease pressures on other parts of the capital stack. And as part of that, and I know we think of CPACE, and it's clearly not kind of inexpensive mezzanine debt. Clearly, it's not mezzanine debt; it has different features. But that seems to be where it slots in. Having that additional 10 million in our capital stack made attracting in this particular instance and getting to closing our senior lenders an easier process.
Mm-hmm. And can you tell us about if you were involved in the application and the processing to obtain the financing, what that was like from the property owner's point of view?
Honestly, from the sort of financer's point of view, with the call it 4 concurrent closings that we did to get that deal done on December 23rd. The process with SEF and Montgomery County was the easiest part of the process. Now, we had started a good bit earlier. We had our energy study done. Obviously, we had all of our plans, but the approval process, the feedback process, obviously we were done with CPACE before we were done with our mortgage lender and EB-5.
And you mentioned that CPACE functioned as a less expensive form of mezzanine debt in this particular transaction. Did the savings relative to conventional mezzanine debt, those savings, did you use that just as an additional cash flow to make the whole project work well, or did you actually design or rethink how the project would look based on the fact that you had less expensive mezzanine financing?
It was a little bit of both, in that we were able to make some changes where where it where it made sense, but it was clearly an integral part of getting the deal done, which was probably the paramount thing in our discussions. But yeah, in looking at the long term, I mean, obviously we have construction debt, and term wise, the CPACE is the longest term, but we're also it's going to be a project that's going to be here for a long time.
So you're giving a very rosy picture. You're making CPACE sound like it's something that people should really take a look at. Were there any challenges that you want to call out, or about CPACE that you were unexpected?
Well, not. I mean, we were successful certainly with the hotel. We have, we've been looking to apply where we're in some of our other projects, bring CPACE in, and certainly, there certainly is a need to educate, and get a broader acceptance of CPACE financing. I think it's kind of tough, with existing, lenders, depending on where you are at loan to cost. But I think that's probably the one thing is that we were kind of on the, in discussing with the lenders, we were doing a lot of education, throughout last year, as the program became active here in Montgomery County, and we have a good number of projects in Montgomery County. So like I said, getting the word out is probably the thing that has been the most difficult.
One of our viewers on the webinar asked about prevailing wage requirements. Do you know if any of those came into play on your project?
Not directly, but as a part of some of our other requirements, it did.
So it was not a requirement of CPACE, that's what you're saying?
I don't believe so, but it was in certain other aspects of our funding requests.
Right. So I will turn now, if I can, Doug, I'm going to turn over to Jean, and we'll get the financier's perspective. And we certainly welcome any questions in the from the audience. Type them into the chat function. So Jean, as a banker myself, I know just how, I know what my first reaction would be when if someone came and said, I've got a project that is going to require you to consent to a senior mortgage. I'm not sure how many seconds it would have taken me to, but not many, to be very cautious. What was your experience like? Fulton Bank has, I guess, consented on 2 or 3 projects now. I'm interested if you might first tell us about your background as a banker before we turn to the particular transactions. Go ahead.
Well, good afternoon, and thanks for inviting me to speak. I'm a career banker, and I'm not going to tell you how many years, but it's a long time. I've been with a few banks in the Philadelphia region. My current role is in the commercial community development lending team at Fulton Bank. You can see Fulton's logo in the corner of my screen. And we focus on projects that provide affordable housing or economic development in low and moderate income neighborhoods, and specifically projects with complicated capital stacks like low income housing tax credits, new market tax credits. And they all have to have a component of some sort of financing that will restrict the use for low and moderate income folks. So that's a little bit about me and what I do. The project we're I was first introduced to CPACE was a project that was an adaptive reuse of a formerly industrial building. It was going to become mixed use, residential and retail and office space. And the project was already under construction when costs escalated and there wasn't enough money, and the borrower, much to their credit, went about looking for alternative sources of additional funds to complete the project rather than just coming back to the bank. And my reaction, Cliff, was very much like yours when they said not only would the financing be senior, but that it was going to be secured with a tax lien. So that gave us immediate pause, and we had to educate ourselves, and we had to learn about the program, and we had to learn why that wasn't going to be a problem. We also had to take the program or talk about the program and educate our credit committees and the senior folks at the bank, who were also going to have to be aware and consent to the use of CPACE in the project. So we did all of that. And fortunately, we were able to build a case that made sense. It made sense for this project, which is just about 100%. We're at like 99.9% complete right now. So initially, our concerns were about permitting a lien that was senior to ours. There's also impact on the value of the real estate. And so you talked about how it could increase the value of the real estate because the energy components would be new and might be more valuable. But we were concerned that it might decrease the value of the real estate because there's an additional assessment.
Right.
And so while it's not part of your loan to value calculation as on the debt side of it, it does come into the calculation because the operating expenses are now increased by the amount of the assessment. And so it does reduce NOI. And it's hard for bankers to wrap their brains around something that's a little bit soft, like energy efficiency. We're going to reduce our energy bills. So without specific evidence of that, we did have to kind of look at how that was going to affect our debt coverage ratio. And that was important to us. I've done a project where CPACE was anticipated at a time when we were doing an appraisal anyway. And so we were able to ask the appraiser to take into account the impact of the assessment and make sure that the valuation included that. And for me, that was important. It was also really important to our credit committee. So I just wanted to highlight that. There's a benefit, but there's also the flip side to that.
Absolutely. Before you go a little farther, Jean, I wanted to clarify two things, or at least ask you about two things. The first is that there is a third-party professional engineer who is performing an energy analysis of the improvements that are financed, the property improvements that are financed with CPACE. And so that analysis is supposed to provide a professional engineer's expert opinion on energy savings. And so there should be, at least in theory, you don't have a track record yet when you receive that opinion, but there should be a projection of energy savings that offset or either partially or entirely offset the extra cost of improvements that are financed with CPACE. How did your credit committee think about that? It sounds like the appraisal was most important, but I wonder, how did your credit committee think about the third-party engineers' expert view on utility savings?
That would would really be something that would substantiate the borrower's pro forma, in my view,
Right.
which would include energy costs and the assessment. So we asked for an updated pro forma that included both.
The second question,
And
sorry, go ahead. I didn't mean to cut you off.
no, I was just going to say it wasn't material to our DCR calculation. So that was one of the reasons we were able to get comfortable.
Right. And the second question I wanted to clarify is very important from a banker's point of view that took me a while to really deeply understand and internalize, which is that this is a tax assessment in the sense that it's an extra charge that goes on, that's collected at the time of the tax bill, and it has the same lien priority as a tax bill. That's what the lender is consenting to. It's almost as a very similar to an intercreditor agreement. And however, and that is naturally what makes every banker, or at least this former banker, very cautious. But what's different is that this is not an accelerated, in the event of a foreclosure, the CPACE financing cannot be accelerated and paid and collected prior to the first mortgage held by the bank. The only portion that can be collected in a foreclosure are the delinquent payments that haven't been made, just like tax payments that haven't been made. In a foreclosure process, future tax payments are not part of what's collected, and similarly here, future CPACE assessments are not collected. How did you educate and explain that very important difference to the credit committee?
Pretty much the way you just did.
That's how I did it. Okay.
You did a very good job. Yeah, that was critical to making everybody feel comfortable. The other thing that we did was that we decided to escrow CPACE assessment.
Yeah.
Much like you would escrow taxes or insurance.
Yeah.
And so that gave us a year's cushion. So if the project were to go south, we'd have a year to kind of get through whatever process we were going to go through before the next CPACE assessment would be due. It certainly also would be an early trigger that maybe there was something going wrong that we needed to be talking with our borrower about. So that got everybody a lot more comfortable.
Sure. That makes, I think that's prudent and very conventional established banking practice to escrow for taxes and sometimes insurance as well, right?
Yeah. The other thing I wanted to highlight is that the transaction that I was most involved with, there was a period of time during which the assessment could not be prepaid, which was a 5-year period. And then after that period, it could be prepaid at any time. And that was really important to us as well, because we weren't sure that a purchaser would want to take the property subject to an assessment if we ended up having to sell it. So the ability to pay it off and get rid of it before disposing of the property was, and that might not have been the most elegant of ways to describe it, but that was important to us as well. So having the ability to prepay, we found, was helpful as well.
So ultimately, your credit committee, would you say they were sort of grudgingly willing to consent, or did you end up seeing the value reflected in the appraisal that made the credit committee, a wholehearted supporter of this?
Not only did they get on board pretty easily, but we actually had one credit officer that we spoke with first, who became our champion among the credit officers. And he was very quick to appreciate that this was not going to be a one-shot deal, that it was likely to be something that was going to expand across the footprint for the bank, and that we ought to be talking about this from a policy standpoint for the bank as opposed to a single transaction type situation. So we feel like we got very enthusiastic response from our credit officers, understanding how this could be really useful.
I appreciate that. It takes, in my experience, it has to take some real comfort to reach enthusiasm in your credit community. So that's credit in the sense of compliment to the people who explained it and the people who were making the decision. Would you, if you don't mind, say a little bit about the different transactions that Fulton Bank has been involved with that involve CPACE?
Sure, I'd be happy to. And just for everyone's edification, I'm willing to reveal who the borrowers are because they actually agreed to case studies, which are published on the, I forget which website, but they're published, and they're case studies for CPACE. And so for that reason, I'm comfortable saying that the first transaction I was describing for you is called J Central. It's that adaptive reuse. It's the properties in Fishtown. It was joined kind of twin buildings that, as I said, were industrial use and were converted to apartments with retail below. And as Shannon described, CPACE only applied to the commercial components of those properties. So the property needed a condo declaration needed to be filed on each building. So we ended up having 4 separate condos. And that project, as I said, is nearly done, and CPACE was a huge help in that project, which was also a historic tax credit project. Another one of the projects that I'm involved with is the Met, which I think a lot of you in Philadelphia might be familiar with. And it was really helpful for them. That money came in after the project was completed and was really useful in helping them to rebalance their capital stack and get some more affordable capital in there, replace some less affordable capital.
That was a refinance.
And then the third, that was yeah, I guess that would be considered a refinancing, yeah.
Or recapitalization, yeah.
Yeah. Mm-hmm. And then the third one is called Golaski Labs. It's in Germantown. And that's another adaptive reuse of a industrial building, which remained commercial, but there was another component that was new construction that was residential. So again, condominium structure was used to separate the commercial from the residential. That project also had seen escalating costs through COVID, and so it was during the construction process that CPACE came in and helped to fill gaps that appeared during construction.
There's a question in the chat that I wanted to pose to you and maybe to Doug if he's still there, which is if you have a feeling for what is the size range of project that you would consider appropriate for CPACE, sort of what is minimum size that would justify the work involved, and what, if you know, I can answer the question about the high end, but I'm interested in your thoughts about where the sweet spot might be, both Doug as a developer or the guy that pushes the numbers around the page, and Jean as the consenting adult to this transaction. What do you think about minimum and maximum size? Doug first, and then Jean.
Well, our experience, we've looked at CPACE in projects that have capital stacks of $50 million or more. And then into the six figures, and in kind of a range from the hotel, which is new construction, to projects we've already completed, to kind of in between. So we haven't looked at it hasn't been part of our smaller projects. There aren't that many that really would qualify right now. It's just we tend to be focusing on kind of larger build outs right now. So it's been larger larger CPACE, kind of no less than, call it 6 or 7 million, and have certainly looked at north of 20 as well, in the context of, like I said, pretty large projects with extensive amount of work done or being done.
Jean, what's your view on the sweet spot, minimum or maximum size?
Well, what I learned is that the capital provider, the CPACE capital providers, are going to have minimums. So the J Central project used a capital provider that was also their historic tax credit equity investor. So that made a lot of sense for them. The Golaski project approached that same capital provider and found that their project was going to be, or the CPACE loan was going to be smaller than the capital provider's minimum. I believe it was under $1 million. I think $1 million was that capital provider's minimum.
Yeah.
So what do you guys think?
Well, our trade group includes 14 different capital providers, and you're right that generally the capital providers see a fixed amount of work of underwriting that has to go into a CPACE project, and therefore larger projects are more profitable generally than smaller projects. That said, there are capital providers that provide CPACE loans as small as a couple of $100,000, but there's more activity once a project gets up to $1 million. The largest project that has been closed to date was, this is public information, was 111 Wall Street in New York City. The first New York City project had $89 million as the CPACE financing in its capital stack. So there is so that's the largest transaction that's been completed to date. Before the $89 million project, there was in Salt Lake City a $54 million project, the construction of a Hyatt Regency hotel. There's a question in the chat about the disbursement process. This may be a question, again, both Jean and Doug have experience with. Did CPACE fund all the proceeds into escrow at closing? And a question that says, I'm assuming the work was inspected by the bank's inspector. Who had to approve the disbursement of the CPACE funds? That's an important mechanical question from the bank's point of view. Doug, do you recall from your experience?
Sure. So CPACE did not fund into escrow per se, although we're paying as if we were. So it's a regular draw process. The most senior funds aren't going to be used until after most of the other funds are utilized. But the mortgage lender is controlling the draw process and the inspection process. So it's basically in the hands of the mortgage lender with a normal, as you would anticipate with the AIAs and everything else, a normal draw and inspection and lien waiver process.
Jean, in your experience, how does Fulton handle it? Or I guess Fulton was not the lender. Oh, yes, you were. on one of the new construction projects? How did that work?
Well, none of them were new construction at the point where CPACE came in. So even though it was still part of the initial construction process, the energy initiatives had already been completed. So the CPACE lender funded in full directly to the borrower because the work had already been done.
I see. So
yeah.
by the time the
Yeah,
bank
so-
was dispersing, the CPACE money was already in the project.
The energy components were already completed. So the CPACE lender dispersed directly to the borrower, and then the money came into an account at our bank, and then they included how they were going to use the CPACE money through the rest of the project. That makes sense. But yes, it was our inspector. We were still controlling disbursements of our construction loans, so we wanted to see that CPACE money get used up appropriately as either with or before the rest of our construction loan.
Right. And that makes sense to me. There's a note here to mention to the audience that the case studies for projects can be found on the webpage of philadelphiapace.org. And those would be, of course, the Philadelphia, geographically located in Philadelphia projects. And I'm sure that Sustainable Energy Fund would have the case studies on its website, which is the SEF.org. We still have a few minutes left in the scheduled time slot. We have just over 5 minutes left. So if you have other questions, feel free to drop them into the chat or the Q&A. Let me ask a question, Jean, if I'm not catching you on the back foot. Do you think that Fulton would ever consider itself being a CPACE lender? Is that something you've considered?
It's something that I also brought up, but I don't know kind of where it might go from there. So I can't speak for Fulton. We haven't decided to do it yet.
Right. I can say that nationwide, we are seeing a small number of banks sort of dip their toe in the water here and see if they might want to find a funding source or whether their treasury function can manage the interest rate hedge for the long-term CPACE financing, or alternatively offer CPACE with a price reset built into the terms of the loan. So that we have seen a couple of banks take a look at this, both in terms of originating CPACE transactions or alternatively purchasing from originators CPACE transactions that they would then hold in portfolio. Doug, have you had any banks take a look at originating CPACE loans, or it may be too early in the Pennsylvania program life for that to have developed? We
actually have one that we're working with on a prospective transaction I can't get into. So the answer is yes, where their bid includes both a mortgage loan and a CPACE loan, separate within their umbrella of companies, but part of the same capital stack. And separate transaction. We also had a CPACE lender bring with it a lender that they had worked with in other situations to pitch the whole capital stack or bid the whole capital stack that way as well. So we're seeing the sort of lag in acceptance being overcome by the kind of more aggressive and clever lenders and providers. Okay.
That's very helpful. There's a note in the chat box asking where the audience might find a recording of this presentation, and the answer is that, well, there she is. She mysteriously appeared. Shannon, why don't you give us the final logistical wrap up on the recording and any other final comments? Go ahead.
Perfect. We will most definitely be sending this out to all attendees, whether you were present or not. But there was one question that was outstanding that I wanted to address real quick. It is, if a workout foreclosure process spans multiple years and no assessment payments are made, can the CPACE funder collect multiple years of unpaid assessments at ultimate property sale? So that's the answer is yes. And here in Pennsylvania, the counties, there's 67 of them, they all have their own different process of how and when foreclosure will officially happen after a couple of delinquencies. Some of them might be within a year or 2 years. So we're going to follow the customary and usual practices within that county. So say if it's 2 years, then those 2 past due payments would be due at the foreclosure, and all the future payments would not be due. So just to wrap that up real quick. Thank you all. Thank you, Jean, Cliff, and Doug. It's really great to hear from people who are the boots on the ground that are doing the projects and the work. You can only go so far with hearing and reading about things. So it's really nice to hear your stories. Thank you for taking the time and sharing your experiences, and hopefully we'll have more to share in the future.
All right, thank you.
Thank you very much, Shannon. So long.